For weeks, a host of stock market experts have been expecting the arrival of a full-blown market correction amid growing COVID-19 case numbers and probable tax rises. That has the potential to frighten you. But what does it mean? Should you be concerned? Thank you for joining me today. In this video, I will explain the possibility of a major market correction that might occur in 2021. Everything said in this video is for entertainment purposes only and is just acting as your source of interesting information. We recommend that anyone considering investing their finances conduct active research before putting their money on the line. What do you have to know about market correction? A market correction is defined as a decline of 10% to 20% in market stock index, such as S&P 500 or Dow Jones Industrial Average, from a recent high. Corrections aren't always bad. In fact, they've traditionally been seen as adjusting prices to better represent their real long-term worth. It's stressful to watch the value of your assets tumble. According to Sean Snyder, head of the investment strategy at Citi U.S. Wealth Management, market pullbacks are common and occur most years. He claims that the news is no cause to cease contributing to or withdraw cash from a retirement investing account. It's also not certain that a correction is on the way. Analysts have been wrong before. However, if you have money invested that you might need in a year or two, such as for a mortgage or vehicle payment, you should think twice about investing it entirely. Even if interest rates are low, financial experts recommend storing cash you'll need in the short term in a readily accessible, safe account. When it comes to investing your money, don't get caught up in the present. Instead, concentrate on the process over time. What are the causes and history of the market correction? Different factors can induce market downturns, such as the one that happened in early 2020. After the fact, explanations are usually simpler to find. The causes of recent downturn markets have varied. After a long-running bull market, for example, a protracted bear market began in early 2000 and lasted until early 2003. The bursting of a stock market bubble in technology equities, notably certain early-stage dot-com businesses, was the most noteworthy driver of the substantial decline in share prices. A rise in housing prices, which proved unstable, fueled the bear market from 2007 to 2009. Too many property owners were heavily indebted and unable to repay their mortgages due to a lack of financial stability. This cheap lending climate wreaked havoc on the financial sector, necessitating extensive government involvement. Investors are only now waking up to the realities of COVID-19 epidemic in February and March of 2020. Investors momentarily lost faith in equities due to concerns about the uncertain consequences for the economy. That dip, of course, was brief, and those who stayed invested in equities have subsequently reaped the benefits. Is the market correction here? Since late March 2020, when the COVID-19 epidemic was still in its early phases, the stock market in the United States have done exceptionally well. The S&P 500 stock index, which means large-cap U.S. stock performance, had drooped more than 33% in less than a month at the time. Since then, the index has rebounded spectacularly, recovering about 90% of its value by mid-June 2021. Because the stock market has seen such a spectacular upturn in such a short period, some investors are afraid that the stock market may be at risk of another big fall shortly. Forecasting when a market downturn will occur over any short period is completely speculative. History has proven that timing large market swings, whether higher or down, is difficult. However, based on what is already understood about how the market is valued and how the underlying economy may influence investor behavior, the topic is worth exploring. The stock market's recovery, which began in 2020, was fueled by significant fiscal and monetary intervention. The Federal Reserve was the one who intervened with money and other central banks around the world. They slashed short-term interest rates to near 0% and injected considerable liquidity into the financial markets. Notably, in fixed income securities, simultaneously the U.S. government approved a series of COVID relief legislations, putting hundreds of billions of dollars in government funds to work in the economy. Direct payments to people increased unemployment compensation for those who lost jobs due to the epidemic, and financial assistance to struggling companies were all examples of this. This support boosted investor confidence and helped to kickstart and sustain a new bull run in equities. It's vital to note that market corrections are a common occurrence. Market dips can be more extreme in some conditions, such as what occurred in February and March of 2020, but they can also be easily overcome. If you're concerned about the current state of the markets, it may be time to evaluate your risk tolerance and reallocate your assets to minimize your portfolio's stock exposure. Check in with your wealth advisor to make sure you're happy with your existing investments and that your portfolio is still on track to meet your long-term financial objectives. Thank you for watching this video. Make sure you subscribe and hit the bell button to get instant notifications when we add new videos in the future. Don't forget to like and share this video with others so that they can benefit from it. Thank you and see you next time.